Hey guys, my name is Swasti and welcome to Wealth Acad. So today we shall talk about how to read a company's balance sheet. So bear with me, the information is going to be a little dry, but it's going to be really useful when it comes to analyzing a stock. So a balance sheet actually shows a company's financial standing at any point in time. Right? You can see a company's current assets, liabilities, and as well as shareholders' equities. So the general formula is that the assets must always be equal to the equities plus the liabilities. So that's how the name comes about, the balance sheet, because one side must always be equal to the other, so it's always balanced. So I know that sounds really complicated, so let's simplify it. Let's say you're buying a car that is worth 50k. Okay, so you have 20k in hand, which you made a down payment. Alright, and then you borrowed 30k from the bank and then paid that. So total, that's 50k, right? So now in this case, your asset will be your car worth 50k. And at the other side of the equation will be your liability, which is your loan of 30k, and your owner's equity, which is your own money that you put in of 20k. So let's dive into the different components in a balance sheet. So I shall use Alibaba's balance sheet for an example in this video. So first thing that we can take a look at is current assets. So assets are pretty much anything that is of value to a company. Okay, so current assets are generally things that can be converted to cash at any point in time, like quickly, which is why these are generally like their bank account or their short-term investments where they can sell easily and get the money, or things like office supplies and marketable securities. So next we have long-term assets. So these are assets that cannot easily be converted to cash. So we have things like long-term investments, which the company is not planning to sell anytime soon. Properties such as maybe the land itself, right? And as well as intangible assets. So this can also involve things such as patents and goodwill. So now how do we analyze a stock for its assets? So a common misconception that a lot of people have, they assume that a company with a lot of assets is doing well. But the thing is, right, let's say they took out a big loan from the bank to, buy a machine that helps the company grow, right? But here's the thing, right, the machine is actually bought off a loan. It's actually a liability, but this is also considered an asset in your balance sheet. So technically the machine is owned by the bank. Alright, so that's something that you might want to take note of when researching on a company using the current assets. So next will be liabilities. So way to put it is liabilities are just debt that we owe, the company owes to others. Right, liabilities are not always a bad thing, right? Because you do need to put in money to actually make profit. So just like assets, we have current liabilities and we have long-term liabilities. So current liabilities is something that you might want to take note of because it needs to be paid within a year. So let's say they have a large sum of money that they need to pay off within that year, you know that the stock price might actually drop somewhere, right, the minute they pay this large sum of money. So one of the things that we want to look out for are companies that are spending more than they are earning. So we don't want to be investing in such a company because you know that they are not very profitable. There are even companies out there with no debt such as Google and Apple, really big firms, okay? So these are companies that you can consider investing in. So moving on, the third part, right, will be the shareholders' equity. The shareholders' equity in a balance sheet refers to the amount of money invested in a company. So some people also refer to this as the book value of a company. So here you need to see, right, there might be two reasons why a shareholder equity is actually growing over time. So the first will be retained earnings. So this means that the company has retained its earnings and maybe used it to, let's say, invest back in their business or has held on to their profits. So this will actually cause the shareholder equity to rise, but let's say a company made a lot of profit, okay? And this is a dividend paying company and they decided to pay it all out in dividends. Then the shareholder equity will actually be stagnant. So you might want to see what's their dividend ratio, how much they pay, right, if the shareholder equity is the same. Then you also have number 2, which is raising capital, right? This is when a company sells their own stocks. This might not really be a good or bad sign. It doesn't really imply anything, but it's also a reason for the shareholder equity to rise. So you might want to identify what's the reason why it's raising or why it's not. So last but not least is financial ratios. This is my most favorite part of the balance sheet, right? It tells me whether I should invest in a stock or not. So there are a lot of ratios to actually look at, but for this video, I'm just gonna highlight the most important ratios. So the first important ratio will be current ratio. So the current ratio is just the current assets divided by the current liabilities. So generally we want a number that's high enough, maybe at least 2 and above. Obviously not too crazy high, because that will mean that something's wrong somewhere, right? If there's so little liabilities. So the higher this ratio is, the better it is for investors. But not in all cases. So for example, banks in general have very high debt. So you can't really use the current ratio in this case because it will be very low since their debt is generally very high, right? Also, you might want to see companies that have high debt and low current ratio. For example, Tesla. Right, it might not be the best to actually invest in such companies. But I'm not saying that Tesla is not a good company. It's just one way to analyze a stock. So the next is debt to equity ratio. So generally, as a rule of thumb, we want a ratio of less than 0.5. So this generally means that we are trying to avoid companies that have a debt exceeding 50% of their actual assets. Even though not all debts are bad, it might not be the best thing to actually invest in a company that has really high debt. So last but not least is the price to book ratio. So we want to take a look at the book value of a company. So let's say the book value, alright, is $50 and the actual current stock price is $40. That means that your stock is undervalued, right? Because it's cheaper than the book value. So this actually creates a window of opportunities for investors like us to go and buy their stock. But be careful, this is just a gauge. Don't just buy a stock based on the book value, right? It's the real value of a company that counts. And this is said by Peter Lynch himself. If you want to read more, I'll link his book down below, One Up on Wall Street. Do take a look at this book. I think it's a good read. And yes, with that, we are at the end of our video. These are just ways that you can identify or read a balance sheet. Just remember, don't rely on any one of this. For example, if a debt to equity ratio is more than 0.5, doesn't mean that the company is not good. Okay, be sure to research more on other factors that might affect the stock. And with that, I shall conclude this video. Thank you for watching. Please like the video, leave a comment down below, and subscribe for more videos in the future. And I'll see you next time.